Prices aren't rising. Your money is shrinking. Gold is sitting near $4,162 an ounce. Silver is holding above 51. Not spiking, not crashing, holding. That's the paradox. In a normal market, prices this high would pull back fast. But they didn't. They stabilized, and that tells you something uncomfortable about the system you're using every day. Big banks aren't treating this like a trade anymore. They're quietly resetting expectations. Targets that once sounded extreme are now treated as baseline, not because metals suddenly changed, but because confidence in fiat currencies is thinning out layer by layer. And this isn't abstract, this reaches you directly. Your salary, your savings, your purchasing power. When gold and silver reprice like this, they're acting as a stress gauge for the monetary system you're trapped inside, whether you chose it or not. But here's the part nobody is saying out loud. These prices are forming while most people still think everything is under control. So the real question isn't why metals are expensive. It's what happens when belief finally breaks. What you're watching isn't a random surge. It's part of a pattern that's been building quietly, then all at once. By late November 2025, gold was trading around $4,162 an ounce. Silver stayed above 51. Those levels didn't come from retail frenzy. They were reinforced by institutional expectations. Major financial institutions began projecting much higher targets into 2026, not as outliers, but as reasonable scenarios. That shift matters more than the numbers themselves, because this wasn't driven by one headline or one crisis. It lines up with a broader reevaluation of real assets versus paper claims. Banks adjusted forecasts upward repeatedly, not aggressively at first, but reluctantly, step by step. That kind of movement signals adaptation, not speculation. Notice what's missing from the public conversation. There's no single event being blamed, no crash, no emergency meeting, just a slow normalization of prices that would have sounded impossible a few years ago. So here's the question that reframes everything. If this is happening without panic, without headlines screaming collapse, what does that say about the pressure building underneath? Because this story doesn't start with fear, it starts with acceptance. Here's the claim that changes how you read this market. Gold isn't leading this move. Silver is. Silver didn't just follow gold higher. It stayed above $51 while liquidity thinned, volatility increased, and forecasts kept moving up. One major institution projected silver to outperform gold next year, not because it's safer, but because it's structurally tighter. Lower price per ounce means broader access. Thinner liquidity means emotion moves it faster. That combination is explosive. Now add a concrete detail most people skip. Price targets aren't flat. Silver is expected to close near 53, then test 60 in the first half of 2026. That's not a casual estimate, that's a stress scenario becoming central. What does that imply? This isn't just about investors hiding, it's about a metal being pulled in two directions at once. Financial demand on one side, industrial demand on the other. And this is where the story sharpens. Silver is being consumed, not just stored. Artificial intelligence, military production, and especially solar. Forecasts show silver demand for solar panels rising from about 240 million ounces today to 450 million ounces by 2030. Nearly half of annual global mine supply locked into one industry. Now notice what's missing. There's no matching plan to double production, no surge in new supply, no easy substitute. When demand grows exponentially and supply can't respond, price stops being a quote. It becomes a rationing mechanism, and that's when markets stop behaving politely. Now watch how fast this escalates. This isn't the first time a commodity faced rising demand, but what's different here is how quietly abnormal conditions are being treated as normal. Structural deficits in silver aren't new. What's new is that this is now the fifth consecutive year they've persisted. That's not a cycle. That's a breakdown. In past squeezes, price spikes were violent and brief. Supply responded, demand cooled, balance returned. This time supply can't respond fast enough. Mining expansion takes years. Refining capacity has limits. And industrial demand isn't discretionary. Solar manufacturers don't pause because prices rise. Military contracts don't wait. AI infrastructure doesn't slow down politely. Here's the comparison that matters. In previous commodity booms, investors were the problem. They rushed in, drove prices up, then left. This time, investors are competing with factories, with governments, with energy policy. And instead of calling this a warning sign, the market is absorbing it. Prices above 50 are no longer treated as extreme. They're treated as the new operating range. That's normalization. And normalization is dangerous because it delays reaction. It pushes pressure further into the system. So ask yourself this. If persistent shortages are no longer triggering alarms, how much strain is being hidden before something finally snaps? Here's where the story stops being theoretical. On paper, silver is liquid, tradable, priced every second on screens. But in the physical market, that picture is breaking down. Dealers began abandoning traditional reference charts and switching to direct exchange pricing because the gap became impossible to ignore. At one point, the spread between quoted spot prices and real wholesale prices blew out to nearly $2 an ounce. That's not noise, that's fracture. Refineries and wholesalers stopped pretending the numbers matched reality. When pricing references no longer reflect what metal actually costs to replace, they get discarded. And that forces everyone downstream to reprice in real time, not based on what investors see online, but on what supply actually demands. Here's the contradiction that matters. Officially, the market says silver is plentiful. Unofficially, every step of the physical chain is acting like it's scarce. Refiners prioritize certain forms, wholesalers ration access, retail pricing drifts further away from spot, and this detail changes everything. When the paper market and the physical market stop moving together, price discovery breaks. At that point, the number you see isn't a value signal anymore, it's a lagging indicator. This is how stress shows up before panic, not with headlines, with technical adjustments most people ignore. So the real signal isn't the price on your screen, it's who quietly stopped trusting it. This is where the system starts choking on its own volume. As prices push toward $54 an ounce, the public rushed to sell. Scrap silver flooded in, alloyed silver, old jewelry, coins pulled out of drawers. Refineries responded by running non-stop 7 days a week. And it still wasn't enough. Backlogs stretched from weeks into months. But here's the part nobody expects. That flood didn't create liquidity. It destroyed it. Dealers rely on refineries to recycle inventory and free up capital. When refineries jam, that loop breaks, cash gets trapped, storage fills up, and suddenly shops stop buying, not because demand is weak, but because the system behind them is frozen. Notice what they didn't deny. Demand for investment silver stayed high, yet dealers were forced to turn sellers away, not due to lack of interest, due to lack of throughput. Now watch how fast this escalates. When reverse liquidity disappears, secondary markets seize. Assets people thought were instantly sellable become temporarily illiquid at the worst possible moment. This isn't a price problem, it's an operational failure under stress. And it raises a dangerous question. The pressure doesn't spread evenly. It concentrates. As refineries backed up, they didn't treat all silver the same. They prioritized gold, then pure silver. Alloyed silver was pushed to the back of the line. Sterling, old circulating coins, 90% silver. Dealers suddenly had no exit. No refinery intake meant no way to convert inventory back into cash, so they stopped buying it. Overnight, assets people assumed were liquid became untouchable. Someone holding old silver jewelry or constitutional coins discovered something brutal at the peak of prices they couldn't sell, not because the metal wasn't valuable, but because the system couldn't process it. Here's the uncomfortable lesson. In stress markets, liquidity isn't about what something is worth. It's about what the system can handle. Standardized high-purity products kept moving, everything else stalled. And that flips a long-held assumption. Silver often gets marketed as flexible, divisible, perfect for any scenario, but under real pressure, flexibility disappears. Only what fits cleanly through the pipeline survives. So now the crisis stacks. Refinery bottlenecks, dealer capital frozen, public locked out of selling, price discovery distorted. What happens if this continues? Now shift the frame. This isn't about traders or dealers, it's about you. When markets behave like this, the impact doesn't show up on a chart. It shows up in real decisions. People lining up at shops, phones ringing non-stop, buying not because the price looks attractive, but because trust is fading. Dealers reported demand stronger than during the pandemic, not speculation, fear trade, and fear trade has a pattern. Experienced buyers wait for pullbacks. They buy quietly. New buyers rush in on green candles, afraid the door is closing. At the same time, others panic in the opposite direction. They dump collections built over decades, sometimes at discounts, just to get cash while prices feel high. This is where ordinary people get squeezed. You're told silver is at multi-year highs, so you should feel safe. But spreads widen, products disappear, liquidity becomes conditional. The price says one thing, reality says another. If this feels familiar, say so in the comments. Because once markets start rewarding fear and punishing patience, they stop being neutral. They start transferring value from the late and emotional to the early and prepared. And that shift never announces itself in advance. Here's the part that most coverage never explains. This isn't chaos. It's incentive mechanics doing exactly what they're designed to do. When trust weakens, capital doesn't disappear. It migrates. Systems reward behavior that reduces exposure and punish behavior that depends on smooth functioning. Paper claims rely on confidence. Physical assets rely on throughput. When confidence wobbles, throughput becomes power. That's why bottlenecks matter more than headlines. Refineries decide what moves. Wholesalers decide who gets access. Pricing becomes a negotiation, not a quote. And once that shift happens, control quietly concentrates upstream. Notice the asymmetry. Institutions can wait, they can warehouse, they can negotiate supply. Individuals can't. They face storage limits, cash needs, timing pressure. The system doesn't need to outlaw anything to steer outcomes. It just lets friction do the work. This is how stress gets absorbed without collapse, not through dramatic failure, but through selective flow. Access tightens, optionality shrinks, and participation becomes conditional on scale and patience. That's the unsettling insight. Markets don't break evenly, they reorganize. And once they reorganize, reversing that structure takes far longer than anyone expects. From here, the path forward splits, and neither option is clean. One direction looks controlled, prices continue grinding higher, pullbacks stay shallow, institutions keep accumulating quietly, supply stays tight but functional. In that scenario, nothing breaks, but access keeps narrowing. Metals become harder to source, more expensive to replace, and increasingly concentrated in fewer hands. The system holds, but only for those already inside. The other direction moves faster. A policy misstep, a confidence shock, a sudden demand surge that overwhelms already strained infrastructure. In that case, price doesn't lead. Availability does. Products vanish, spreads explode, and official prices lag behind reality by days or weeks. Here's why uncertainty matters. Both paths can exist at the same time depending on who you are. Large players experience continuity. Smaller participants experience friction and delay. That divergence is already forming. Notice what's happening right now. Banks raise forecasts, mints expand capacity, physical flows accelerate across borders. Those aren't reactions to panic, they're preparations, which suggests the next move isn't a surprise, it's already being positioned. Here's the insight that ties everything together. This isn't a story about silver or gold. It's a story about what happens when trust erodes quietly instead of collapsing loudly. Prices don't scream, systems adapt, friction replaces failure, and by the time most people notice, the rules have already changed. When metals hold at levels once considered extreme, that isn't a signal of excess. It's a signal of repricing, not of assets but of money itself. And repricing doesn't reverse quickly, it resets baselines. The next phase won't begin with a crash, it will begin with normalization, with people accepting wider spreads, longer waits, fewer options. That's how transitions happen without permission. If you want to understand where this leads next, don't watch the headlines. Watch the bottlenecks. Watch what moves easily and what suddenly doesn't. That's where the real story continues. Follow and subscribe if you want clear, calm analysis as this unfolds.